Welcome, class. Okay, let's jump right into this. Today, we are tackling an absolute foundational accounting topic in our explainer, FAR210 Topic 7. We're going to thoroughly master payables and figure out exactly how we account for them under the Malaysian Financial Reporting Standards, or MFRS. So, whether you're aiming for that solid A in this course, or you just really want to understand the bedrock of corporate debt, well, you are in the perfect place. Grab your notes, get comfortable, and let's get started.
All right, here's our quick roadmap for today's explainer. Number 1, we'll meet your payables. Number 2, MFAS rules and recognition. Number 3, spotting the imposters. Number 4, journal entries in action. And finally, number 5, those all-important final exam takeaways.
Okay, Section 1, meet your payables, the foundation. Let's just strip away all the heavy jargon for a second and look at the absolute basics. To put it in the simplest terms for you guys, payables are literally just your short-term debts. When your business buys, say, raw materials or services just to keep the lights on, and you don't hand over cash right away, boom, you've created a payable. These pop up all the time in the ordinary day-to-day course of running a business. And typically, these debts are due in a really quick 30-day turnaround, though, sometimes a generous supplier might give you 60 or 90 days. But the key here is it's short-term, it's routine, and it is absolutely essential to track. If you ever forget what carrying a liability actually feels like, just picture someone lugging a massive, incredibly heavy green bag of debt on their back. That is exactly what a business is doing when it takes on payables. As an accountant, your entire job, your main mission, is to perfectly track, manage, and eventually unload that burden so the business stays healthy. So your big takeaway here is simple. Payables are just routine, short-term debts that you absolutely must carefully manage.
Moving on to Section 2, FMFR's rules and recognition.
Under FSRS 32, a financial liability is strictly defined as a contractual obligation to deliver cash or another financial asset to another entity. Now, I want you to literally highlight 2 words in your notes right now: contractual and cash. There absolutely has to be a contract, and the ultimate settlement has to be cold, hard cash, or at least an equivalent financial asset. Listen, if it doesn't meet this precise definition, it is not a financial liability.
To give you a bit more context, here are the standard examples you're going to see over and over again in your homework, your quizzes, and your eventual exams. We're talking trade payables, term loans from the bank, promissory notes you've issued, bonds, debentures, and even deposits received. In every single one of these scenarios, there is a clear, undeniable contract that forces the business to pay out cash at some point in the future.
But here's the million-dollar question. When do we actually write this down in our books? Well, under MFRS 9, you can't just record a liability whenever you feel like it. You have to clear 3 specific hurdles. First, you must officially become a party to the contract, meaning you actually signed on the dotted line. Second, relevance. It's got to be highly probable that cash is actually going to leave the business. And third, faithful representation. You have to know the exact amount so it can be reliably measured. I mean, if you don't have the exact invoice amount, you definitely can't faithfully represent it. So to sum this up, you need a contract, a probable cash outflow, and an exact amount to faithfully record the liability.
All right, on to Section 3, spotting the imposters.
Okay, class, wake up and grab those red pens. You absolutely must learn to differentiate between true financial liabilities and what we call non-financial liabilities. As we just learned, a financial liability means you owe cash based on a contract. Simple. But a non-financial liability? It kind of looks like a debt, but instead of cash, your duty is to deliver goods or perform a service, or maybe the obligation actually comes from a statutory government rule rather than a mutual business contract.
And here is the #1 trap students fall for. I guarantee, literally guarantee, you will see a warranty question on your test. So remember this, warranties are not financial liabilities. Why? Because think about it. When you issue a 1-year warranty, you are promising to fix a broken product or provide a repair service. You are not handing out cash. And because the outflow is a service, it completely fails the MFRS 132 definition.
Here is another huge exam tip to save you from losing easy marks. Deferred or unearned revenue? Not a financial liability, because again, you owe a service, not cash. Statutory taxes like income tax? Also not a financial liability. Now you might be thinking, but we pay taxes with cash. True, but the obligation comes from a statutory government law, not a mutually signed business contract. Keep these imposters straight in your head, and you will save yourself so much grief. Remember, if you owe a service, goods, or a statutory tax instead of contractual cash, it's an imposter.
Let's dive into Section 4, Journal Entries in Action.
We are going to apply all these MFRS rules to a real-world scenario with a company called Lisa BHD, just to see how we actually record these numbers step by step. So we're going to track Lisa BHD over a quick span of 8 days. On September 20th, she makes a purchase. On the 22nd, she realizes some items are defective and returns them. And finally, on September 28th, she settles the bill while taking advantage of an early payment discount. Let's break down the actual math here.
Step 1 is the initial purchase. Lisa buys goods with a gross price of $10,000, but she manages to score a 6% trade discount. Class, listen very carefully to this rule. Always deduct the trade discount first before you record any journal entry. A trade discount is just a bulk buy price reduction. It literally never appears in the journal. So 10,000 minus 600 gives us a net amount of $9,400. We simply debit purchases for $9,400 and credit accounts payable to YY Berhad for $9,400. Easy enough, right?
Moving right along to step 2. 2 days later, Lisa finds some defective items and returns $2,500 worth of goods. This is great for her because it directly reduces what she owes to her supplier, YY Berhad. To record this, we do the exact opposite of our payable entry. We debit accounts payable for $2,500 to shrink the liability, and we credit purchase returns for $2,500. So her new outstanding balance is now exactly $6,900.
Finally, step 3. It's September 28th, and Lisa is paying early to get a 5% cash discount. Now, unlike trade discounts, cash discounts actually are recorded because they're a reward for early settlement. So we take that $6,900 balance, multiply by 5%, which gives us a discount of $345. This means Lisa only pays $6,555 in actual cash. The journal entry: debit accounts payable for the full $6,900 to entirely clear the debt. Credit purchase discount for $345 to show your savings, and credit bank for the $6,555 cash actually going out the door.
If you lay out the narrative of an accounts payable lifecycle like this, it becomes crystal clear. You see the balance peak at $9,400 on the 20th. Then it drops to $6,900 after the returns. And then, beautifully, it just zeroes out entirely on the 28th after we record the bank payment and that sweet purchase discount. So, the ultimate summary for our journal entries: trade discounts are silent, returns reverse the balance, and cash discounts are explicitly recorded at final payment.
And finally, Section 5, Final Exam Takeaways.
I want you to really lock these 4 rules into your memory tonight. First, know the strict MFRS 132 definition. It has to be a contract for cash. Second, do not fall for those exam traps. Warranties and taxes are imposters. And third, remember your golden math rules. Trade discounts are deducted silently before you write a single journal entry, while cash discounts are fully recorded to balance out your final payment.
Before we wrap up, I'll leave you with this final thought to ponder. If your future business consistently fails to pay its 30-day trade payables, how will suppliers quickly ascertain your company's true credit status? Keep in mind, mastering payables isn't just some academic exercise to pass FAR210. Proper disclosure of payables allows suppliers to monitor you, and failing to manage them can literally destroy a company's real-world credit reputation. All right, thank you so much for joining me for this explainer class. Study hard, and I will see you all in the next one.